So if you look at the life cycle of a company, right from an early stage company or when the company is born till it hits IPO and then it becomes a multi-decadal company or a generational company. There are various investor appetites, various investor risks, or like what we call the risk reward profile. As the risk in the company keeps on going down, so does the reward expectation also come down. So, for example, Bloom, which would invest in a seed stage or a pre-A stage, our expectations are that every check that we write should give us at least a 10 bagger return on our investment. As a company grows, becomes closer to an IPO, the risk profile of that company has drastically gone down. And at that point, a different risk profile investor, let's say a pre-IPO investor or a private equity investor or a public market investor could come in and say, hey, I'm ready to take on this risk, even if the IRRs are, 20-25%. And believe me, like 20-25% IRR in public markets are very good returns, right? Because I think the Nifty compounding over last 20 years would have been even lower than 25% for sure. Right? So with that background, typically at that stage, these kinds of investors, which I talked about, be it pre-IPO investors, private equity investors, or mutual funds who want to have small exposure before the IPO and then increase their exposure in the IPO, those are the guys who come in, and the VC investors would want to probably offload some of their holdings and hold the remaining as the company grows. And this is what you would have seen, for example, even in urban company, wherein some investors and founders who sold, the new investors who came in the last round, they would want to hold it for a longer period of time and ride the public market.